So a big hello to all my peeps out there struggling with their own social dilemma. Great documentary on Netflix, by the way. You should check it out.
I'm not aware of that.
This is Mike Mills with Verity Mortgage coming to you today with mortgage information that you should know. So most people I talk to when it comes to buying or selling a home or refinancing or whatever bring up two topics. Number one is interest rates, and number two is that dreaded mortgage insurance. What is mortgage insurance? Mortgage insurance is something that you have to pay when you don't put 20% down on your home when you purchase it. Now, how much is it? What's the rates? That all kind of varies. Mortgage insurance is kind of based on a couple of factors. What type of loan you're doing, how much money you're putting down, and what's your credit score. So real quick on the different types of mortgage insurance and the different types of loans. VA loans have no mortgage insurance. So congratulations, if you can get a VA loan, you don't have to mess with this. USDA loans, they don't have mortgage insurance, but they have something called a guarantee fee, which is very similar, but a little bit cheaper. So you still pay an extra fee for not putting any money down, but it's not quite as much as some of the other loan programs. Then you have an FHA loan. FHA loans carry mortgage insurance no matter how much money you put down. And it's at least for 11 years. And if you put the minimum down, which is 3.5%, you're gonna have mortgage insurance on your FHA loan for the life of the loan. The only way that you can get rid of it is to sell it or to refinance into a different style of loan. So that brings us to conventional loans. Conventional loans mortgage insurance is determined by a couple things. Number one is if you put 20% down, you pay no mortgage insurance. However, if you're going to put down anything less than 20%, the mortgage insurance is going to be determined by your credit score and your down payment. So let's focus on conventional mortgage insurance because this is the type of mortgage insurance that you can get rid of. With conventional mortgage insurance, you can kick it out of the house like a 25-year-old son still trying to find himself. So let's say you put down 5% on your house and you want to save all that extra cash to put into your home. You want to put in new flooring, you want to put in new kitchen countertops, you want to add improvements to your house instead of putting that 20% down. Well, once you make those improvements and you have everything fixed up the way you like it, reach out to your local realtor and ask them to run a current market analysis on your home. They can tell you whether or not with the improvements, your house is going to hit a certain value if we get an appraisal done. Now, is it a guarantee? No. It's still an estimate and it comes down to what the appraiser thinks, but at least it gives you a gauge on whether or not it's worth a shot. Now it comes to what do I have to do in order to get this removed? So what you want to do is you want to reach out to your current servicing bank. This is the bank that you pay your mortgage to today. And you want to ask them to do an appraisal on your property and a reconsideration of value so you can get rid of your mortgage insurance. Now, the catch is you're going to have to pay for the appraisal. You have to reach out to the bank. It's usually going to be somewhere between $400 and $600. The bank actually has to order it for you. So you can't call your buddy Joe, who's an appraiser, and come out and take a look at your property. They don't allow that. The bank's going to reach out. They're going to send an appraiser to your home. That appraiser is going to walk through the house, check everything out, see your upgrades, and submit a report. You'll get a copy of this appraisal report once it's completed. And if the house now has a value that's greater than 20, that gives you 20% equity in your home, they will remove the mortgage insurance. Now, the catch on that is that the mortgage insurance premium you have to carry for at least 1 year in most cases. Some mortgage insurance companies require 2, but in most cases you have to have it for at least 12 months. After that 12-month period, then it's eligible to fall off. So if you bought a house under market value, put a little less money down and you wanted to get rid of it in less than 12 months, you couldn't. But after that 12-month period, if that house holds the same value and your loan balance hasn't increased too much, then you can get rid of the mortgage insurance pretty easily. Ultimately, all of it depends on the appreciation of your home. Sometimes if you're in a hot market like we are right now in Texas, your house will appreciate on its own over time because there's such high demand for homes in your area. So if you bought your house for $200,000 3 or 4 years ago and now it's worth $250,000, now you don't have to pay mortgage insurance anymore. The process is still the same. Call the bank, get the appraisal, pay for the appraisal, have that MI removed. But you can get rid of it. You don't have to wait the normal 8 to 10 years before it falls off. So it's as simple as that. There's no need to refinance. All you have to do is get the house reconsidered on its value and you can get your mortgage insurance removed as long as it's been a minimum of 12 months. Hey, this is Mike Mills again with Verity Mortgage. I really appreciate all your time. Please forward and share this video. Make any comments. If you have any questions, let me know. Always feel free to reach out to me. Be good humans and we'll see you soon.
I'm not aware of that.